Hello and welcome back to another episode of The Trenches. This is crypto's number one podcast where we talk, sorry, taking the reverb, where we have conversations with the most important founders, investors, and doers in Solana and the crypto ecosystem more broadly. I'm absolutely thrilled to have Sam with us from North Island Ventures. Sam has an incredibly impressive background, and I think being in the venture community as a professional in crypto, it allows me to get to meet incredible investors that may not have the same degree of being on every single podcast every single week. Really find the people who are actually doing the work, not just speaking about things. And I've learned a lot from Sam over the past really 3 or 4 months that we've gotten to know each other, and so I really look forward to talking more about markets. The markets are bleeding, maybe a slight recovery over the past couple of days. So in this episode, we're going to talk about the markets. We're going to talk about MicroStrategy and some of the updates there. I think more broadly, we're going to talk about liquid. Sam runs a very large liquid book at North Island, and we're going to talk about valuation and how he thinks about tokens and opportunities more broadly. So, Sam, thanks for coming on The Trenches. Incredibly excited. Let's start with a quick introduction. You have a pretty interesting career before starting in crypto. So maybe tell everyone a little bit about yourself and what brought you to crypto in North Island.
Sure. Thanks for having me on, Carl. And yeah, it's been great connecting with you, and I'm sure this will be one of many fun riffs. Okay, so my background, I've been a crypto investor for several years now. I focus on public crypto investing, which means like Bitcoin on down to smaller market cap tokens, crypto linked equities and derivatives. And I do that in the capacity at North Island Ventures. North Island Ventures is a crypto focused fund launched about 5 years ago. We have both venture strategy and call it like a hedge fund, and I oversee the hedge fund. And my entire professional life has been in public markets investing, and my formative investing experience prior to crypto investing in North Island in particular was at a hedge fund called Blue Mountain Capital. It was a $22 billion hedge fund. I spent almost 9 years there, all on the investing team, originally investing kind of distressed and stressed credit, and then being a part of our team that grew our long short equity strategy. So all fundamental based, and looked across a number of different types of securities and geographies. And that experience proved to be really formative to what we do today. Some of it very relevant, some of it less relevant. And part of my experience in my hedge fund days is actually what led me to crypto. And then kind of 2020 for me was the real kind of light bulb moment in DeFi summer of like, wait a second, there is really something here. And the type of investing that I had been doing previously, or up until that point, more on call it like public equities, some degree of that could lend itself to crypto. And that was a bit the light bulb moment for me.
That's terrific. And it's when thinking about crypto, it seems like global liquidity is the best, highest level framework that we have to understand crypto prices. Obviously, there's idiosyncratic movements and alpha across different projects as they grow, but generally, so goes Bitcoin, so goes the market. I'm curious from your experience in sort of say public equities and traditional markets, and some degree of macro experience as part of that. What is your starting point and worldview in terms of where crypto prices go, and generally over what time period are you thinking about price?
Okay. Maybe I'll work some of those questions backwards. So over what time period are we thinking about price? Like, we are very much thesis driven investors. We ideally, want to own things we're underwriting, call it several years. And that is very difficult in crypto because the volatility is so high, the cycles kind of come and go as rapidly as they do. And the moats of some of these protocols, these businesses, are either questionable or starting to emerge. And so that makes it all much harder, and the valuation metrics are a little bit harder to triangulate. And so these are all things that historically we've kind of like grasped to. This is like investing more broadly, we grasp on to give us conviction to like build this position size. And all that is harder in crypto as a result of the kind of market structure. But but those are some of the things we're considering when we're underwriting investments. To your first point around like broader liquidity, the reality, and I think it's an unfortunate reality, but it is the reality, in the last, call it decade plus, across all in public markets investing, liquidity has become more important, and that's because the Fed has played an oversized role relative to, say, the 2000s and in the early parts of the 2010s, insofar as liquidity, whether that be setting rates or combination quantitative easing or quantitative tightening. And so I think back of like my hedge fund days in long-term equity, like 10 years ago, we weren't focused on what the Fed was going to do at every meeting, whether or not there's going to be a basis point cut or something like that. Whereas today, like it's impossible not to follow what's going on with the Fed. And so global liquidity has played a larger role in all public markets investing today versus 5, certainly 10 years ago. And crypto, particularly Bitcoin, tends to be at the tip of that spear because Bitcoin is viewed as a global macro asset that obviously trades 24/7 and is a barometer for risk appetite or speculation, if you will, right? And we see that now in, call it like non-crypto hedge funds, either trade around Bitcoin a lot, or banks banks that trade non-crypto assets, which is pretty much all banks, are giving a lot more commentary on Bitcoin, and that's driving some of the concerns of kind of what's transpired in the last couple of months markets wise is like the movement in the price of Bitcoin.
Yeah, it's fascinating to me. I remember talking to somebody who spent a lot of years in in macro. They're like, you're going to spend 7 years in macro to really get it. And I was like, come on, is it really that hard? Rates go up, rates go down. The Fed does this. But you start to realize that even if rates are staying the same, there's all these other types of operations they're doing to increase and decrease liquidity in the system. And so I feel like every time you start to think you understand, again, I'm not a professional liquid investor, so it's, I don't have the same degree of experience as you, but as soon as I start to understand it, I'm like, oh, wait, they can do that. And there's some other balance sheet operation taking place that's totally separate from just rates going up and rates going down. So it does seem like liquidity continues to be the number one driver. And but it's increasingly challenging, I find, for the average person to really understand is liquidity going up or liquidity going down. So that's been like one of the biggest challenges for me is to try to really dig in and understand some of these different drivers, because again, like we're also making some liquid investments out of the firm and obviously have a PA. And so we need to understand, is liquidity going up or going down generally over the next couple months? And so when you look at opportunities, like let's say there's a particular token you want to buy, as part of that, I would love to understand your framework. So do you start with, do I think the market's going to go up over the next 3 months or down more broadly, and then look at the specific opportunity? Because, for example, I can imagine a situation where, you're like, hey, this is a good buy, but I actually think it's going to be a better buy in 3 months because the market's going to, liquidity is going to continue to tighten. Kind of walk us through when you find an opportunity, like how do you start to think through, okay, this is a good opportunity. The market is right. The timing is right.
Yeah, I guess first off, whatever I share here, this is certainly not financial advice.
Yep.
This is my own personal thoughts, views, certainly not financial advice, legal advice, tax advice, all those disclaimers. And my views may not necessarily represent those of the firms.
Yep.
Okay, so your question of like, when we come across something of interest, like, is the first question, do we think the market's going up or down? That's generally not the first question. I generally think of like, we have to be a realist of we have to be aware of what's going on in the market. But like, I don't think of myself as a macro trader. I think very few people are actually expert macro people. And so we tend to, or certainly that is something we're aware of, but it's not the macro tail wagging the dog, right? What is most important for us is like, what is the quality of the protocol or the company or whatever it is that we're investing in that is being built. What is the problem it's addressing? How is that problem, how is its solution being better? And what is the economic model? And like, how is this thing going to grow and how is it going to go profitably?
Mm-hmm.
And then how does that value accrue to the token or the asset that we're buying, right? That's the kind of like, we go into that in a lot of depth and we kind of develop a thesis on like how we think this is going to grow, and then focus very intensely on like the key tenets of the thesis that we think are really going to move the underlying asset price. That is, I think, what's most important from a bottom-up standpoint.
Yep.
And then I think of like a top-down assessment of, okay, what is the state of generally more markets, crypto in particular, and that helps gauge how much risk I may want to have in a portfolio at any given time. So it's a combination of like this top-down, a bit macro, but kind of thematic view, and bottom-up asset selection.
That makes a lot of sense, and I think we see something similar where we see teams that the metrics continue to get better and better, but the prices keep going down. And so there's times where you have that bottoms up point of view. This is a good protocol, growing economics, growing utility, adoption, et cetera. But the markets are going down. And so at that point, I'm assuming you're saying, great, as that happens, it's essentially lower and lower risk to start investing if you've seen a big drawdown and have a point of view on where liquidity is going to go over the next 3 to 6 months.
Yes. I'll preface that with a couple things.
Yep.
One, in an environment like crypto specific, in an environment where Bitcoin is going down, is going to be very hard for anything else to perform. Like correlations in public crypto are very high. And in down markets, the distribution is very narrow, meaning that like everything goes down and everything goes down quite a bit.
Yep.
But then in rallies, the distribution is wider, meaning that like everything's going to perform when markets are rallying, but some things are going to perform even more. So you have a wider distribution on the upswing and a tighter distribution on the downswing, which kind of suggests like when things are going down, you kind of want to pare back risk because you're not really going to be able to call what's going to outperform. Whereas on the upswing, you have a better chance of calling what's going to outperform. Because there's a couple of kind of things to consider about, and like, when Bitcoin's going down, it makes it harder for anything else to perform.
Let's talk about Bitcoin a little bit. I actually have, let's see if I can pull this up. Here's a chart of Bitcoin, hopefully on the audience, you can see that well. But this is single day looking over, let's just start it over July. I mean, basically since October, we've been trending downwards. And so every time we think we start to have a relief, there's continued price suppression relief, continued price suppression relief. Maybe like just walk us through what's been going on for the past 2 months. And when we were chatting a little bit, you were talking about the markets are just really skittish, as seen by the different headlines and how dramatic an impact a single headline can have on the market. Walk me through what's going on in your view, your assessment of the market over the past 2 months. And then from here, is this actually a point of like a new floor, where I would say floor from a technical perspective, but are we kind of through most of the bottoming, or do you see that this is just another trend of slight relief and then you continue downwards price?
Okay. So just like high level, what's gone on in the last 2 months. First, what happened kind of crypto specific was this flash crash on October 10th.
Yep.
Right. Whereas like $20 billion of liquidations of like OI pretty much came out of the market in the span of like 30 minutes on Friday at like 5 o'clock Eastern Standard Time.
The worst time. You think you go to home for the weekend and all of a sudden,
and that was, and given the magnitude of it and the reaction that like no one really saw that coming. Yep. Right. And it was a combination of a Trump tweet with like some challenges of what was going on in Binance. And that had a magnified impact because it was so violent and so big. And what transpired after that was there were a lot of parties, likely market makers, that incurred like pretty significant losses, not surprisingly, right? And probably a bunch of retail traders, like everyone incurred losses off the back of that. And so what that meant is that liquidity dried up significantly in the market, right? And that goes from like Bitcoin, and certainly more when you start going out like smaller market cap tokens. All of a sudden liquidity was totally thin, which means there's no demands in that order book. And so what would happen, or what we saw transpire, is all of a sudden volatility picked up, right? And you saw like Bitcoin vol spike, and that's the volatility for across all other assets spiked even more. That was a crypto specific thing that happened. What just happened to coincide around about that same time, and actually started a little bit before that, more like mid-September, but accelerated after October 10th, is two things in regards to Bitcoin. One, the Bitcoin and gold kind of decoupled. They had been trading roughly in tandem, and just as of like really kind of end of August, September, as gold really ripped and Bitcoin did not, that became a problem, and people kind of clued into that. The other thing that started happening is Bitcoin and kind of crypto as an asset class more broadly started underperforming equities. And that sets up like a two-pronged problem whereby, okay, Bitcoin's not really trading like digital gold, and it's not really trading like a risk-on asset. So then like, what is it really trading like? Like there's a problem here. So that was the third thing that happened. Sorry, the second thing that happened. So we had like the crash, and then the decoupling between gold and equities. And then the third thing that happened, which was not crypto specific, is particularly as of like early November, end of October, early November, there was more widespread concern around the AI trade unwinding. Right? The NASDAQ had been on a steady march up since early April, up about 40%. And just like, you rarely see the NASDAQ move up that steadily, that quickly. And then there were a whole bunch of kind of AI related, tangentially related kind of high flyer stocks, and valuations were higher, and people just started getting concerned around that. And so you started having like a sell-off in AI related names, and that kind of had a knock-on effect across risk assets. And we found ourselves then in a period where, Bitcoin and kind of crypto by and large was just going down, and then like equities were selling off, and it was sending Bitcoin down even further. And that's, that third dynamic of the AI trade unwinding that had a knock-on effect to like risk assets, Bitcoin being a prime example of that, as of like early November. And the interesting thing that we observed is that alts, if you look at like, there's different ways to cut alt indices. Alts actually held up relatively well in November in comparisons to the decline we saw in Bitcoin.
Yeah, it's pretty wild to see how, you're right, there's sort of this magical moment where it was around early November where, there was obviously a drawdown on the AI side, and I think people have started to rebuild confidence since. Gold obviously just continuing to perform well, and just during this down, it's like when the market goes down, Bitcoin just goes down so many more standard deviations, it seems, than other assets. Because to your point, it's the tip of the spear in terms of risk appetite, especially for traditional funds. Like they're not buying what we call alts. To them, Bitcoin is one of the alts that they're looking at. And so when liquidity dries up, or they need to de-risk the book, it does seem like Bitcoin gets hit really hard.
Yeah, and on the liquidity point, I mean, there were also what had a somewhat of an impact during this period was the government shutdown. What happens in the government shutdown is you have the Treasury General Account, which is thinking about as like the checkings account for the government. Money keeps coming in because we're all still paying our taxes, but money's not going out the other way. Right. And so that was like a modest impact, minor impact. But as we think about like liquidity sources going forward, there's a few things that are happening. Is one, well, we're no longer in a government shutdown. So the Treasury General Account, there's maybe like $200 billion-ish there that's going to come out. Second, as of December 1, like 3 days ago, the Treasury stopped quantitative tightening. Which that adds like $60 billion roughly a month in liquidity.
Yep.
And then third, there's, as a result of the big, beautiful tax bill, we are all likely paying a bit too much in taxes these last like 6 to 8 months-ish. And so you're probably going to get a larger tax refund in the beginning of next year. That could be something to the tune of like 100 or so billion. So liquidity setup is actually somewhat favorable for the
And
next,
maybe a rate cut as well, or an expected rate cut
yeah,
as well.
and the rate cut, that's like pretty well baked in. And we're potentially moving into a new Fed environment that just could have like structurally lower rates.
Yeah.
Anyway, that was a lot of macro talk for someone
No,
who's not a macro guy, but like,
that was really
prep
terrific.
is like getting way deep on protocols and like understanding what like crypto really does.
Yeah.
I think and hope and believe that like crypto will become like less of a macro asset. I think Bitcoin will continue to be a macro asset, and it's kind of carved out its niche there. But I kind of think of crypto as like two separate things.
Yep.
There's Bitcoin, and then there's everything else, and everything else is the enabling technology, and that's the stuff that's far more fascinating.
Yeah, no, I agree. And so perhaps one macro-ish question before we go on to like protocols and valuation and fundamentals. Predicting the future is hard, right? It's very easy. I wouldn't even say it's easy to look back and understand what happened. That requires a whole lot of skill, but predicting the future is always hard. But do you have an outlook for the rest of this year? And maybe the different way to ask that question is, what are one or two things you're watching critically over the next 4 weeks to really determine, hey, are we really starting to move into at least a sideways, if not positive market? Or is this just another uptick in short relief in the general downward trend? Like what are you watching during this season?
Yeah, I mean, the year's over in 4 weeks. Like I just never look at things on like that short of a timeline.
Yeah. Got it. So you don't have a strong view on where we go from here over the next month?
No.
Okay, great. All right. Well,
pretty high conviction view over like a medium to longer term horizon. But like me being able, call where things are going to be in 4 weeks is like, I can't do that. I don't think anybody can do that.
Got it. All right. Well, let's switch then to crypto protocols. I guess when you're looking at opportunities, what are, there's many different types of categories out there, DePIN, DeFi, you could say consumer apps. Is there any in particular over the past 6 months you've been spending most of your time on and find that there's a lot of interesting opportunities?
Yeah. There's a few themes that I'm particularly interested in. These things are probably not going to strike you by that much surprise, but like anything stablecoin, anything tokenization, and then anything that like is an entirely new business that can be built on chain that like couldn't exist in a non-on-chain world. And those are kind of like the three types of themes, and I can even start like a higher level above that as to kind of how we get to those specific themes.
I mean, I agree with those themes, so I don't even think we need to start at the highest level unless you want to. I'm happy to just jump in right there on the stable coins, tokenization, and what was the third one you said?
They're like entirely new businesses that can be
built
on chain.
Let's start with stablecoins. I guess over the past 9 months, I feel like, especially if you're not incredibly crypto native, if you wanted stablecoin exposure, the two things you would do is people said buy ETH because for some silly reason, I know why, but it's kind of silly to me as an investor. People said buy ETH. It's a great exposure to stablecoin growth on chain. The second obviously would be Circle. And I think that really is part of the reason Circle jumped up incredibly high since its IPO. I think everyone in crypto was shocked how high it went. A lot of the stablecoin opportunities, it seems like a lot of them are private companies that are doing stablecoin payment APIs. There are obviously new stablecoin issuers that are being created, but a lot of these don't have tokens yet. So when you think about stablecoins, what are the types of opportunities you're seeing where there might be liquid exposure on the stablecoin side?
Sure. It's not as straightforward as like a Circle or like an either reaction as ETH. We kind of think through second and maybe third order derivatives of what an expanding stablecoin world looks like, and where do those stablecoins go. And one of the things I found like particularly interesting is Aave, which is like a borrow-lend platform that has been around for a while, and it's a fantastic product in what it does, which I can elaborate more. Yep. Like the stablecoin, what's is so fascinating about Aave and stablecoins is that as stablecoin proliferation increases, people have more stablecoins in their wallets and so forth. Like you're going to want to generate some form of return on that, right? And then so supplying that stablecoin into a borrow-lend platform, for example, in Aave, is a way you're going to generate yield. And so what's particularly interesting about Aave is when you look at the share that Aave has had of stablecoins, particularly stablecoins on Ethereum, it has consistently grown over the last 8 months from like low single digits to now like approaching like mid to high single digits, which suggests, and the amount of stablecoins on Ethereum is growing, and growing both in terms of what like largest dollar amount and actually, or depending on which timeline you look at, percentage-wise, it's growing amongst the fastest as well. So you have a ton more stablecoins coming to Ethereum, and then within those stablecoins coming into the Ethereum blockchain, they're disproportionately going to Aave.
Got it.
That that is effectively like an indirect way to get exposure to stablecoin growth. And listen, I've looked at Circle in a ton of detail. The other way, public way to get exposure to stablecoin growth is Coinbase. Coinbase and obviously Circle are very much interrelated. Circle is the issuer of USDC, but what we've also discovered is that right now, it's the most valuable place to be in the in the stablecoin supply chain is the distributor.
Yep.
And Coinbase is the distributor of USDC and has like disproportionately strong unit economics from being the distributor. And so as stablecoin proliferation will increase, Coinbase, an increasingly large, Coinbase generates over $1 billion from its stablecoin business.
Yep. Yeah, it's incredible. I really like your framing, because I feel like too often liquid traders I talk to look at different metrics like TVL to FDV or revenue to FDV, and these metrics, and it's like, well, this one's valued at 10x, this one's 15x, therefore there's an arbitrage. And I guess that's one way to look at the world. I just think crypto's too irrational, and there's too many other dynamics at play that those leave me wanting those types of frameworks. But I think saying, hey, for every dollar that comes in, where is it going? And then investing in those platforms, it seems like a more first principles way to evaluate where future growth is going to go into the ecosystem. So I really like that framing. I think it's really strong. Does that also lead you to look at things? I guess there's sort of the basic borrow lend element, which I think Aave has really carved out its position. And then there's things like what I'd call like private credit or other types of more advanced lending on chain, such as Maple and what they're doing with Syrup. Do you think about those more as the second bucket of tokenization, or do they also fit into that stablecoin bucket?
No, they do fit into that. And Maple is kind of fits in a couple buckets of both, increased stablecoin proliferation. They should benefit from that, and as well as kind of like tokenization. So it does fit into that. What I think is probably most compelling about Aave is like you can go deploy tens of millions of dollars right now into Aave. It can absorb it.
Yep.
You can't really do that anywhere else, or in like most other borrow lend platforms. And there are network effects to this that like Aave being the most kind of battle tested place to like borrow lend platform, and the scale it has to absorb capital makes it kind of like the go-to place to go and deposit large amounts of stablecoins.
Yeah, I love that. Let's go on to the second category you talked about, which is tokenization.
Yeah.
The general thesis here, I'm assuming, starts at the top. There's trillions of dollars in structured products, and those are over time going to migrate themselves on chain. And there's a series of ways to tokenize those assets and make them accessible, and you get better liquidity, secondary trading, all these things. So kind of like take us into your head on tokenization and why is it exciting, and what type, again, I'm not asking you to recommend specific things, but what types of platforms does that lead you towards?
Sure. So high level, what's interesting about tokenization, the kind of joke I make, but I think it's pretty true, is crypto has fantastic rails and like shitty assets.
Yeah.
Traditional finance has great assets and shitty rails, but those two things are increasingly converging, right? And so what we want are like traditional assets on crypto rails.
Yeah.
That's what tokenization does, right? It takes a security, whether that be an equity or bond or what have you, and tokenizes it and puts it on an on-chain basis, right? In an on-chain format, ideally natively, which means it's not some sort of wrapper. It's like natively issued on-chain. And the benefit of that, there's a few benefits which I can outline now.
Yeah, please do.
Okay, so the benefit for the kind of, both the issuer of like the security and the consumer, the person who's trading it, are a few things. For the consumer, now all of a sudden you can take that tokenized asset and use it in a whole bunch of DeFi applications. Now, what does that mean for your average person? That means that your like stock portfolio or whatever else can be used as collateral if you want like a dollar loan, right? Now, if you're a giant like New York-based hedge fund, you don't care for that because you already got a margin loan from your prime credit, right? But everybody else in the world like doesn't operate that way, right? And so that becomes a useful thing. Now, on the issuer side, like there's a tremendous amount of cost in issuing all these securities, right? And particularly like, and once you start tokenizing them, there is a massive cost save for, call it NASDAQ, for example, right? To the point where like the CEO of NASDAQ openly talks about how they want to tokenize everything because from a settlement standpoint, right? We're talking about like instantaneous settlement, programmability, composability. From a cost standpoint, it's going to dramatically reduce their cost structure. And so these are benefits, whether that entirely accrues to the issuer or to the consumer, like it probably gets split up along that supply chain, but there's a ton of like cost benefits and functionality benefits for everyone to enjoy.
Yeah, I totally agree. And so when you talk about bringing on the high quality assets to the high quality rails, there's a lot of different approaches to people are doing private credit. People are doing even just Athena, which is really like a traditional trade, but like structuring it in a way that it's now tokenized. Is there any in particular that you expect to grow substantially over the next year, or that you're like most excited about on the tokenization side?
I think what will be tokenized, like what will be the biggest tokenized asset are going to be U.S. Treasuries.
Yep.
And the reason for that is U.S. Treasuries are the most common asset that's used as margin collateral, or one of, certainly one of the most common assets used as collateral. And the reason for that is like they're completely fungible. It's a massive $1 trillion market, trades a ton of volume, settles like fairly quickly.
Yep.
There's a lot of liquidity in it. And so the benefit of tokenizing treasuries, and all of a sudden now the capital you're posting as margin, and I'm not talking about like someone trading on a DEX. I'm talking about like Goldman's trading desk. I'm talking about like Citadel. I'm talking about Cumberland. I'm talking about like major financial institutions. One of their largest costs on a trading desk is their cost of margin, right? It's the cost of posting treasuries to operate, as collateral for their trades that they're putting on. Now, part of that cost is you got to fund the cost of posting that margin because settlements are like T+1 to T+3. Now, all of a sudden, you collapse that settlement time from T+1 to T+3 to instantaneous, plus you make it 24/7. The cost of collateral for them has come down dramatically.
Yep.
And so that's why, like, I think treasuries are going to be like the first big thing to be collateralized and used at like enormous scale, because that's going to revolutionize how a lot of Wall Street firms operate their businesses.
It's interesting. If you asked me, I actually wouldn't start with treasuries. And not that I'm saying, sorry, not that I wouldn't start there. It's the most logical place to start. I don't think it's going to be the one that really grows. It's the biggest growth story of the next year. And by the way, what I love about being a host is we get to have conversations. It's not just listening, but also engaging. Is I think these higher yield, even if it's like very, very low risk or like very like not as low as US treasuries, nothing's as low as that. It's like the safe haven of the world, but things that might give you 8% at only a marginal amount of additional risk through looping strategies or other approaches that are really possible in crypto native rails. I think those are going to be much more enticing and help people overcome the hurdle to go from off chain to on chain versus like Goldman and others. Like they'll eventually go on, but I don't see them racing to do this over the next year. But like US treasuries, I'd say is the holy grail to start bringing those on. I think so. Some of these 8, 10, 12% vaults are actually going to be a thing that really people start piling into over time. Kind of like how Athena showed that they could just accumulate billions and billions of dollars through this trade. Obviously, that trade has started to, I don't say unwind, but the large yields have mostly gone away. And so now Athena's at an interesting point.
Yeah. Yeah, I think it's more just a debate around timeline. And like, I don't really know. These higher yielding products are attractive and they certainly get people in the door. But what we've seen, in these last couple of months have been another prime example of this, of you actually incur a lot of risk trying to generate a mid-teens return on stable coins.
Yep.
Like there's a tremendous amount of risk that you're taking. And, people are realizing that in these vaults now.
Yeah, I agree. All right, moving on to the last category of just crypto native businesses or unique businesses only possible on crypto rails. What are some of the interesting categories there that is top of mind for you?
Yeah, so there's probably two like real benefits. There's a couple benefits to think about of like on-chain businesses is one, you have a dramatically lower cost structure. And second, you can generally enter markets much faster.
Yep.
Because whenever you're custodying an asset, understandably, there's a tremendous amount of regulation that goes into those types of businesses. So you want to enter a new market. Sometimes you just want to enter a new state. Like there's a whole bunch of new regulations you need to abide by. But now if you can offer a similar service, but you're never actually custodying the asset, that means you can get into markets much faster because you don't have to abide by the same regulations because you're not custodying anything.
Yeah.
So there's a few kind of analogs that pertains to, like EtherFi is something of interest that like fits that kind of that mold, where it's effectively like an on-chain neobank and it benefits from being non-custodial.
Yep.
Which means when it takes on, it doesn't actually take deposits, but it offers banking type services and it has a much lower cost base and can enter new markets much faster. And so that facilitates growth, and not only facilitates growth, but it facilitates growth at a much higher profitability point. So the unit economics are better. So not only you can grow faster, but you can grow faster at a higher profitability, which that's what leads to like hyperscaling of businesses, right? I do believe crypto businesses will have like an even faster hyperscaling trajectory because of this dynamic.
Yep.
There's other, types of businesses that are also kind of only really able to be done on chain. World being a prime example of that. Another something like very interesting, where as we move towards a more AI agent dominated world, determining who is a real human or what agent is actually empowered by a human is incredibly important. And being able to identify that this is a real person is actually like, we're going to need to be able to do that. And the way world is structured of like scanning especially scanning your eyes, having like a proof of that stored on chain that you can share with, an interested party on your behalf, or at your authority. That solves like that problem. And that's only because effectively the data of your eye is stored in a completely secured way. And the owner of it, me in this example, can release it to an interested party. That's another business that like could not exist, can only exist on chain.
Yeah.
I can keep going on.
No, it's great. Those are a couple examples. I mean, I think the perfect example, or another perfect example, on the crypto businesses can grow. They're crypto businesses are global day one. And I think that's something that we've never seen before in history, where if you have a crypto wallet, you can reach anyone in any geography, unlike traditional banks, where, to your point, you need to go get state by state licensors and approvals and country by country expansion. It's a very long, tedious process to get anywhere close to large geographic coverage. And that's why a lot of these, even banks today, are very regional specific. It's just not worth the time and energy to get there. But like Phantom today is global day one, and they're adding more and more neobank capabilities. So global day one, and the ability to, not have the same overhead that traditional businesses have. It makes it incredibly exciting.
Yeah, absolutely.
Yeah. So is there any, I guess, when you think about L1s at this point, there was a big thread on, I think Hasib from Dragonfly wrote on L1s going exponential, that it's going to take time, but these things are going to grow so much faster than any of us could ever imagine. That's kind of been the classic story of Silicon Valley. So you have L1s, and then you also have apps. When you look at your portfolio for 2026, how are you thinking about allocation into L1s versus allocation into apps? And by the way, the traditional market calls them alts. I was on the phone with a market maker today, and I was alts. I'm like, I don't look at the world in alts. Like, I don't buy, for example, we have a position in MetaDAO. Like, I don't look at it as an altcoin. I look at it as an app that's providing a value. So I'm going to structure it as L1s versus apps. If you had I don't want to say like $100, but like representatively, what percent are going into L1s versus apps? And how do you even start to think about that?
I'm generally probably a bit more interested in apps than in L1s. For a few reasons I can elaborate on.
Well, all the themes we talked about are all app related. They're not L1 related, to your point.
I do think this, the kind of fat protocol thesis that has been, the kind of the main thesis in crypto for a while is starting to be undermined.
Yep.
And it's starting to be undermined because although L1s as ecosystems are very valuable, Ethereum incredibly valuable, the value accrual is pretty nebulous and is actually, if it's very successful, should be declining.
Mm-hmm.
Right? And so what you're then relying on is like a moneyness component to the token of the L1 token, which is feasible. And like, listen, that's like Bitcoin has nailed that.
Yep.
Right? But it's not really nailed it. It's more like digital gold. But
yep.
How many more of those type like moneyness type chains you're going to have? And then like stablecoin chains probably further complicate that, because now all of a sudden you're going to be, seemingly settling transaction in pick your stablecoin. Right. Yep. So that is like antithetical to a gas token needing some form of like moneyness component to it. Yep. So that's at the L1 side, and like the valuations of these things, like I don't refute, like it gets kind of hard to justify some of these valuations. Yeah. And probably unlike, I don't know if it's unlike, but the common rhetoric, on crypto Twitter has been like, oh, value it as like a city, value it as like a company. Yeah. My view is like, no, it's neither of those things. Value it on a relative value basis, right? You stack up all the different L1s, L2s, yeah, and like, it's this one as a proportion to that one. And the reality is most assets in the world, credit, FX, are valued on a relative value basis. Right? Like my start of my career as a credit analyst, like I couldn't do a DCF for the price of a bond. I would benchmark one bond versus a whole bunch of other bonds that were like of a similar thing. It's like people asking you what's your price target for US dollar. Like no one's got a price target for the US dollar. The US dollar is relative to other currencies.
Everything else.
Similarly, like an L1 token, an L1 valuation should be relative to other L1s. Now, you may have a view that the entire L1 sector is overvalued, in which case, like, oh, you don't want to go there. But like, there's valuation discrepancies between different L1s and different L2s.
Yeah.
So that's kind of L1 dynamic. And then at the app side, like, yeah, a lot of the stuff we've talked about is all applications, right? And it's my view that like consumers care more about the application, right? I pause it back to you is like, do you really care what cloud service your Uber uses or this, you know, when you're streaming a Spotify song? Like, do you even know? Like, no.
Yeah, you don't care.
You don't know, you don't care.
Yep.
Right. And what is important, you know, and in say, for example, cloud-based computing, is that it facilitated a whole bunch of these other highly valuable applications that couldn't have existed without cloud computing.
Yep.
My view is like crypto is a similar thing in the world of finance, right? It facilitates all sorts of applications that could not exist before. The consumer is not going to care what blockchain this is on.
Yep. Yeah. And I think too, like to add to that, my view of where I wish crypto would be is not actually what's happening in crypto. I'm much more of a fan of the global state machine where I have an address, all of my assets across different platforms are there, and this enables fantastic composability. And in that case, like it starts to matter what chain you're on, but we're going much more to an app-centric world where I basically move money from my wallet into this app. So, you know, I have an embedded wallet in Polymarket, in, in Pump, in every single app. And so in that case, it literally matters almost zero on the back end what's going on. So I think there's going to be different types of chains that have ecosystems that are built where the composability matters, such as, you know, I can then borrow in Camino and I can, borrow in Camino, then I can swap and I can maybe get different types of leverage or invest in tokenized assets. So there's going to be local areas where it matters, but generally the most successful apps, I'm probably putting my money into those apps directly and then engaging with an experience. And you know, the people that are yield farming and doing XYZ across 3 different protocols and care about the global state machine is a very small percentage of the population. And I think as this really grows, you're right that these apps can choose whatever backend they want, hybrid crypto and non-crypto, and actually be incredibly successful. And we'll probably see the best ones supporting multiple chains for various reasons.
Yeah. So I tend to agree with that. And then it kind of leads me to like this next question, which maybe we're kind of, you know, are applications going to be the most valuable thing, or a wallet's going to be the most valuable thing? And I kind of separate those two things as two different things. I mean, they're both kind of applications, but you know,
I think it's apps.
Pardon?
I think it's apps. I'm actually, I think the wallets can make money. Wallets, I think, are moving towards neobanks. Like they're basically like, we're a neobank that can custody your assets, generate yield for you. We can stake your assets. You can connect your money, like sign transaction, connect your money to different places and send, receive. Like neobanks are generally less highly valued on multiples than others because they're more of a commodity than other types of like one-on-one unique apps that just have incredible network effects. So my general view is I would be betting more on apps than I would wallets specifically, but I think wallets are a great business because if you hold the user's assets, then you can monetize every single thing they do with those assets in and out of the wallet.
Yeah. I go back and forth, but my general view is both are valuable. We can debate which one's going to be
more valuable. Yeah. you know what would make wallets the more valuable is actually the team at Backpack. I don't know if you remember this, a number of years ago, had the X NFT standard, where basically you could in the wallet have simple experiences embedded. And to me, that was like brilliant. I'm like, that is how wallets start to make money, is they become an app store. And like our experience with like Surge started, Surge well, helped start the app store at Google. And so if a wallet becomes an app store, then I think they can become huge. But if their ceiling and valuation is based on that of a neobank, I think they're not going to be the largest winners. So I think they need to figure out the ecosystem side to be wildly successful.
Yeah.
Yeah. Well, this has been a great conversation. Is there, in our final minutes, is there anything we haven't covered? Any hot takes you have? Anything you see in crypto Twitter and kind of want to put a point of view up on that we haven't discussed yet?
I think across crypto, we need to get far better at our the language that we use. And what I mean by that is most of these things are not currencies. They're never going to be currencies. Let's stop referring to them as that. These also stable coins, we call them digital dollars or something like that. It's confusing. It's not just call it what it is.
They're just dollars. They're just dollars.
Dollars.
Yep.
Alts, we need to get away from that term, right? The stupidity of the industry, the market is Bitcoin and alts. Really, it's just a few $1 trillion market.
Yep.
And yes, okay, one of the assets is the lion's share, but it's and then we just bucket everything else as alts.
Yeah.
We're doing ourselves a complete disservice here. And then the fourth thing is, yes, macro is important, but in time we need to detach ourselves from just talking about macro all the time and where rates are going and so forth. It's no, let's talk about the enabling technology and how that is literally creating better financial rails.
Yep. One of the reasons I'm also really excited about tokenization is you start to bring assets on that are decorrelated from crypto. So, for example, on Camino and swaps and these platforms, it's generally correlated with the price of crypto. Even staking protocols, it's obviously correlated to the price of the underlying asset. But when you can start to get all sorts of private credit opportunities on chain and other structured products that are not directly a function of crypto prices, you now create more sustainable yields on chain and more reason to always use it rather than, oh, we're in a bear market, there's no money to be made, I'm going to go sit on a beach for 2 years until the next bull. So I completely agree with you.
Okay.
Terrific. All right. Well, thanks for coming on. Again, follow Sam on X, Samuel M. Andrew. Follow Crypto Trenches if you're not already. Thanks for joining us for this episode, and I can't wait to get some of these clips.